Good afternoon, students. Welcome to the mock test counseling session of final paper 6C International Taxation. I'm Priya Subramanian.
I am Aparna Chauhan.
And we will be taking you through the case studies. First, we'll give you the general things which you have to keep in mind for attempting this particular paper. And then we'll take you through the case studies in the mock test paper as to how you have to go, how you have to approach those case studies. So as far as this paper is concerned, basically when we come to what you have to study is the study material. Study material, October 2021 edition is relevant for you, and it comprises of 9 chapters. So, and that is based on the law as amended in direct tax laws as amended by the Finance Act 2021. So that is study material, but actually for the subject of international taxation, it is presumed that you have the knowledge of paper 7 direct tax laws, because everywhere you'll have to integrate and apply it. So it's not standalone that the syllabus is restricted to only what is contained in that material, but the paper 7 is embedded. Wherever you have to apply deductions, even though they may not be separately discussed in your study material in paper 6C, you have to do it. That we mentioned clearly in the initial pages. So that study material is divided to 9 chapters, plus in addition you have to know the contents of paper 7 also. So when you it's a case study based paper basically. So you have to attend 4 case studies out of 5 case studies, and the time limit is 4 hours. So this you must properly keep in mind, that the time limit is 4 hours. And so accordingly, you have to divide, you have 1 hour per case study in general. So it may be possible that one case study takes more time than the other. So don't just stretch it till the last minute. And one challenge here is to read the paper and select the case study. In fact, since there is a choice, you will be tempted to choose the things which you know best. And that might itself result in some time consumption. So in that manner, you have to be careful. You have to be careful that you read the questions, and when you make the choice, you make it once for all. It's not that you select case study 2, then afterwards you find that, okay, I'm not comfortable with it after answering 2-3 questions. Then instead of that, you suggest you'll end up wasting time, because as it is, the time will be, if you have to plan it in such a manner that you don't waste any time at all. You can't afford to select one question, attempt it partially, and then move to another. Your reading time is also wasted, and as well as your whatever time you spent on analyzing a few questions, that is also wasted. So make your choice judicially. Initially itself, do the reading properly. Read the questions. The questions might probably give you a better idea, because the case study will be filled with facts. And when you're doing the initial reading, you might not be able to make out from the facts that whether you're comfortable with the questions to be raised. So the questions are more important. More time on the questions you get, and see whether you're comfortable with it, and go ahead and answer the case study. Just remember, it's an open book examination, but you have to know each and every page of your study material. It's only thing you need not memorize it, waste time memorizing, but in case you forget something, you can immediately consult the material. The material is open, but it's not that in the material itself you have to search where the information is. You have to be so familiar with the material that you will know where you find each content relating to. If suppose you have a doubt relating to a particular rate relating to non-resident, you must be knowing in non-resident chapter that in the first half, second half of that chapter, where to find for that information. So that way you have to be very thorough. That happens only when you read the study material properly, work out all the case studies. As it is, we've given you illustrations, exercise questions in the study material itself. Apart from that, there's a case study digest with 35 case studies. But you must make a conscious effort to do it on your own. After reading the material, you can keep your book open, because anyway it's an open book examination, but do it on your own, and then check your answers with the given answers, so that you know where you're going wrong. If you make an honest attempt, 35 case studies in the case study digest plus 5 in the mock test paper, you will definitely be well prepared for the examination. So that effort is required from your side. So the myth that open book exam you can go without studying, please take it out. That it's much tougher than your normal examination. So you have to put extra efforts and study more well. It's not a question of studying, it's not a question of remembering, it's a question of being able to apply the provisions correctly, identifying which provisions are applicable, identification, that itself the first step, and application of those provisions to the facts of the case. So these are the things basically which I wanted to tell you. As regards the subject wise, topic wise, I'll delve into it a little bit further. Some general instructions you want to add?
Yeah, these are the basic things actually. Now, selecting the four cases out of the 5 is the first task you have to do, and you have to do it in the first instance. Yeah, of course, you cannot take a chance you start doing and then leave it and start doing the another one. You should not do, because selection of case study really very much important. Of course, the time management also, that ma'am said ki you have to manage your time. For that purpose, now you don't have time to open the books and everything to write down your answers. For one main thing, now don't, as it is, copy from the provision. As it is, you should not copy the provisions in your answer sheet. You should see that what is the requirement exactly, what exactly you want to write in your answer for arriving at the conclusion. For that purpose, you write restrict to that provision itself. You don't need to write each and every provision as it is come from the study material, right? This is the one thing. Plus, of course, this one thing for all cases, all the parts of case study should be solved at one place. It should not be the case study one part is at one place and the other part is other place. So you have to solve all the parts of one case study at one place only, right? In the continuation. If you don't know the one part, leave that some space, and when you finish your other cases, you can come again and see. Try to solve try to again make the effort to solve it. Right, this is the basic things. Basically, you have to prepare well. Of course, it's an open book, because we see, yeah, it's an open book, then we can manage it during the exams time, because you have a restricted 4 hours time. In that, you have to manage. So, आपको पता है, you know it, the provision, you know कि आपको पता है कि this is the provision has to be applied in this manner. The facts, actually, you have to analyze the facts of the situation given in the case study. On that basis, you have to write down the provision applied accordingly. So, study is mandatory for this paper as well. Proper study, proper revision, everything is required for open book exams as well. So this is the one thing, right? Let's see if you are receiving any query. We have to see what any query is there. Sumit Jain, yeah, Sumit Jain, you are there in the paper 7 also. You are opting for this one. Now you are asking, I have converted from old course. What should be my approach for this paper?
Whatever we said so far, that should be the approach for this paper. Actually, you should keep in mind that you won't get simple knowledge-based questions, like you might get in the other 4 papers, because it's an open book. So higher level skills are being assessed. So for that higher level skills, you have to sharpen your thinking, and that is possible only if you apply the provisions, whatever concepts, what you learn in international taxation, in problem solving, in case study based scenarios. So let me tell you some of the issues which you have to consider. Like, there are 9 topics. In transfer pricing is the first topic, where it's a very important topic, and most appropriate method for determination of arm's length price. So that, see, it's all given in the material. You have to be very familiar with each method. We've given illustrations also for each method, so that in the exam, when a question is asked, you are able to identify which is the method and apply it after making the functional adjustments and all that. So that is one thing which is important. Then afterwards, the secondary adjustment, 92CE and 94B, interest, excess interest. So sometimes there's an interplay when interest comes by way of an arm's length adjustment, plus you have to apply that 94B, and that you have to take care. What are the specific requirements under both the sections? We have one question like that in our MTP also. Then the penal provisions for transfer pricing, that again is important, and country by country reporting. So these are the main things in transfer pricing. As far as non-resident taxation is concerned, see, those are concessional rates, exemptions for non-residents, special provisions of TDS. So all are there in case of non-residents. Whenever the concessional rates come, it comes along with a particular condition. Like, either you won't be allowed to claim expenditure, or you won't be, in case of capital gains, you may not be allowed indexation benefits. So those accompanying conditions you have to be very careful about. What is this allowed? When I apply this concessional rate, am I denied any benefit? What benefit am I being denied? And then they will ask you to compute as per regular provisions, special provisions, which is more beneficial. So you must know, in the study material, it's all been described properly with the help of charts and all this. The only thing you should keep it, these are the things which you should take care in NR taxation. Then as DTA, double taxation avoidance anyway, it is one of the most asked questions, and students are also able to attempt it very well. So that is regarding DTA. Now, when you come to advanced ruling, this year there has been a change, from authority to board for advanced ruling, and it's taken place in the middle of the year, 1 month. And some provisions have undergone a change, like the binding nature of advanced rulings have undergone a change, and those things, so you must be careful, because a question can be asked on the position prior to amendment and after amendment, since it's happened in the middle of the year.
Yeah, all the pending cases before the AAR will go to the BAR, that board for advanced ruling. So binding nature will undergo a change. If it is decided by AAR, then binding nature is this is binding on the transaction of the appellant or the applicant and the commissioner, that one. But that in case of bar, it is not binding. It is appellable order before the High Court. So this will make a difference. That whom you have made the application to the authority, of course, advanced ruling authority, but it is being since past pronounced by the bar after this date. So the appellability will undergo change in that case.
This issue is also being tested in the MTP. Yeah. Then as far as equalization levy is concerned, of course, there are two types of levy. One, in case of online advertisement, digital advertisements case, where the person paying, the resident paying has to deduct taxes, so deduct equalization levy at 6%. Another thing is a non-resident e-commerce operator engaged in sale of goods or provision of services, and where he has to pay. The non-resident has to pay, e-commerce operator has to pay the equalization levy. So the fine differences between these two.
There are amendments also there in equalization. Those are very important amendments.
And BEPS action plans, different action plans to prevent tax erosion, a country's tax base from being eroded. BEPS has come, the base erosion and profit shifting. Many action plans have come. And Indian tax laws have incorporated special provisions based on these tax action plans. So that also is important, as well as the multilateral instrument. That also is very important. And as far as OECD UN model conventions are concerned, basic differences between the two. It's very important. Like you have a force of attraction rule in UN, you don't have it in OECD. You have a service PE concept in UN, you don't have. So those things are very important. What are the differences between the two? And everything has been discussed in the study material. And as far as UN OECD conventions or application of treaties, BEPS action plans are concerned, that you can restrict yourself to the study material. But as far as the other chapters are concerned, you have to link it with the chapter, with the provisions which you studied in paper 7 also. So that's why when you're going for the open book examination, we advise you that in addition to your study material of paper 60, you take the study material of paper 7, Income Tax Act and rules. And case study digest also you can take, because that is written. And apart from that, if you want to take any other material, that's up to you. But basically, these things are essential.
Yeah, these are the things you should bring it to your exams. We basically ask question, what all material can we take to the examination? So yeah, for the study material, case study digest, and fine paper 7, Income Tax Act and rules are the must things you should bring or take it with yourself. Well, one thing, in case question doesn't relating to a DTA, if question doesn't contain the extract of the DTA, then they have to base your answer based on the conventions given in the study material. You have to take the assumption. If that's a clear question, would clearly state on what convention you have to analyze the things. If it is not, then you based on the one assumption that you are solving the question based on this convention, that you have to clearly state in your answers. In case of other questions also, if it is prone to assumption, if you are have to take some assumption, and that you have to clearly state in your answer that on that assumption you are arriving at that answer. These are the things because these are prone to assumption, different interpretation based things. Those you have to clearly state in your answer.
This happens especially in respect of articles which we have included as part of our syllabus. In that case, they themselves will give you, but maybe they won't give it to you as part of the question. Somewhere in the question, case study discussion, it might be contained that it is in line with UN model convention. So that's why it's very necessary that you read the case study carefully, because it might not all be at one place. It may not be. If it's given, it's well and good, but it may not be at one place. It might be at the far end, like the TTBR rates. Also might be at the end. Sometimes extracts of DTA may be given towards the end of this thing. So you have to look for the relevant information. So that's why time management becomes very important. We'll move to the mock test paper.
Yeah.
Any queries?
No, we can move.
Now,
one thing, ma'am, you should take a pen and paper, solve the case on your own. Don't read the case study digest. That I already also told in paper 7 also, that you should not read the questions. You should solve on your own, then compare the answers. It will definitely help you in better way. Otherwise, what is happening now during the exams, you lack writing skills. आपको ना click नहीं करेगा. The certain points ना, which you feel कि when you read it, you think yeah you know it. But when you start writing, actually, then you realize कि yeah, certain things which you are still have to prepare. So that's the main requirement in all the papers, that you should solve it on your own and then compare the answers. Definitely it will help you.
Of course, you'll make mistakes when you're solving it on your own, but the thing is, right now you can afford to make mistakes. You can't afford to make mistakes in the exam. So if you can make mistakes now, in fact, you should be happy. You are making a mistake because you have an opportunity to correct yourself. So that should be the approach. You should not be scared. Okay, my answers are all coming wrong. Now I should stop. I should just start looking at the answers, and then ultimately you will suffer during the exam.
Don't get demotivated seeing your answer. You have still time.
Because it's a learning process. Making mistakes while solving is a part of the learning process. Take it positively, as of now. But when you reach the exam hall, you must be very confident that time when you face something new, because all the while you're used to solving on your own, you'll gain that confidence. Look, I'll be able to approach even if a new problem is given to me. Now I have the confidence, I know how to apply the provisions. That's the confidence which you have to develop, and that comes only when you do it on your own. It's okay, it's fine if you make the mistakes. Just as of now, it's fine if you make the mistakes when you're practicing. So, because by making the mistakes, then you will go through that, what mistakes you made, so that you won't repeat it in the examination.
But don't get panic seeing the facts of the case studies. Don't try to analyze the facts of the case study. You have to, answer the questions, whatever asked. So, see the questions, and don't get panic at the first instance. When you start doing that, you will definitely recall the thing, and you will definitely approach also. You can do. So don't take any kind of stress seeing the facts. Oh my God, these are the facts. This type of questions. Okay. Don't try to analyze the facts. You have to understand the requirement of the question. So do read the questions. Right. This is the one thing that you have to manage that time without taking any stress. When you are free, then you can perform better. So this is the one thing. Now we can take the case studies in the MTP.
Okay. Let's start with the first case. What we have done is, your MTP questions we had posted, and a couple of days later we posted the answer. In this, what we have tried to do now for the counseling session is, after each set of information in the facts, the related questions in the we have brought it. So after reading the facts of a particular paragraph or one or two paragraphs, we've brought in the relevant questions so that we can raise it. So this matching, you must be able to do it when you're doing the examination. See, because by and large, all information have a corresponding question. Maybe sometimes, okay, some extra information is given, but by and large, they have seen to that there is some question or the other based on that. So you must be able to relate the questions to the facts and answer them. So accordingly, we merged it together so that you can understand how you have to interrelate the questions with the facts and then proceed to answer. Okay. Now, case study 1. ABC Company Limited Cochin is engaged in diverse business operations. The income tax assessment was pending before the AO for assessment year 18-19 as on 1/4/2020. AO made reference to TPO for determination of ALP. Upon receipt of TPO's order, AO forwarded the draft assessment order to ABC Company. AOC filed the objections against the draft order with the DRP and the AO. The DRP gave its directions on 1/9/2021, and the AO passed the final assessment order on 28/9/2021 in accordance with the directions of the dispute resolution panel. Okay. Based on these facts, there are two questions. One is an MCQ. MCQ asks, if ABC Limited does not file its objections, does it have recourse to any other remedy at a later point of time? And there's a descriptive question. We'll take the descriptive question first because it will help you to understand the provisions, and thereafter the MCQ we can take it up. Examine whether the assessment made by the AO on ABC Company Limited as per the directions of DRP is barred by limitation. That is, Also state the appellate authority before whom the assessee should file an appeal against the such assessment order. Now, what is said, whether barred by limitations, whether the time limits, various time limits have been complied with. That's what they want you to check. And these are based on the provisions of 144C, where the DRP issues directions and the assessee can file the objections before the assessing officer. Now, we have to see whether how the provisions of 144C apply to the facts of this case. Okay. Now, first we have to check whether the assessee is an eligible assessee. That is, an assessee is eligible to file objections before the DRP. Now, who is an eligible assessee now? Eligible assessee can be either a non-corporate, non-resident or a foreign company, or any person in whose case variation arises on account of the order of the TPO. In this case, what happens? We put it before also. ABC Company Limited, Cochin. So it's not a foreign company. It's not a non, but it's the case in which the variation arises as a result of the order of the TPO, because AO has made a reference to TPO for determination, and upon receipt of TPO's order is passed. So the variation is arising as a result of order of the TPO. So ABC Company Limited becomes an eligible assessee. Now, if the variation is prejudicial to the interest of the assessee, if it's going to affect, if it's going to result in higher tax liability, the AO has to forward the draft order to ABC Company Limited. Okay. Now, ABC Company Limited has a time limit of 30 days to file objections. If it's satisfied with the order, it can file its acceptance with the AO. But within 30 days, it has to file its objections within it can file its acceptance also. But in this case, it is not applicable because ABC Limited has objections. So it will not file its acceptance. Suppose the ABC company files its objections. It has to do it within 30 days. So 30 days of receipt of the draft order. The question states the draft order is received on 31/2021. I picked up the facts from the question only. So how many days you have? 30 days from 31/2021. 30 days is what? One more day I have in January. I have 28 days in February. Now it comes to 29 days plus one more day I have, 1st March. So on or before 1st March I have time to file the objections. ABC Company Limited has filed it on 15/2/2021. So that is before 1/3/2021. So it is within the prescribed time limit. So suppose the AO had not, suppose the assessee had not filed the objections. Then what happens within 1 month? Suppose it did not file any objections. Then within 1 month from the end of the month, in which the 30-day period expires, AO has to pass the order. But that is not applicable in this case because the assessee is filing objections. Now, what happens when the assessee files its objections? The DRP has to issue directions to the assessing officer within 9 months from the end of the month in which the draft order is forwarded to ABC Company Limited. So when is the draft order forwarded? It was forwarded on 31/2021. So the end of the month is 31/1/2021. And 9 months from that date is 31/10/2021. So DRP has to issue directions on or before 31/10/2021. In this case, DRP has issued directions in 1/9/2021, which is within the time. Now, what will the AO do? How much time does the AO have? DRP has issued directions to the AO. AO has to complete the assessment based on the directions of the DRP within 1 month from the end of the month in which the direction is received. Okay, in this case, the direction was received on 1/9/2021. Okay, so DRP has given. So 1 month, it's not 1 month from 1/9/2021, from the end of the month. From 30/9/2021, 1 month, which is on or before 31/10/2021. By this time, the AO has to complete the assessment. Now, in this case, AO has passed on 28/9/2021. So it's before 31/10/2000. So it is within the stipulated time limit. So everything has been within the stipulated time limit. The AO has filed this, the assessee has filed his objections before the 30-day time limit. 15/2/2021 itself, it has filed, though it had time up to 1/3/2021. DRP had time to issue directions, binding directions by 31/10/2021. It has done it by 1/9/2021 itself. AO had time up to 31/10/2021, but it has done it on 28/9/2021 itself. So everything is, and so the order is not barred by limitation. That is what the question asks us to check. Also state, just see that. Sorry. Should we reduce the size? No, just. But it's coming. I think we made similar. Yes. In the end.
Yeah.
Yeah. So when we go to the question, what does the question require?
None. We used it.
Yeah. The question requires examine whether the assessment made by the assessing officer on ABC Company Limited as per the directions of DRP is barred by limitation. No, we've seen it's all within the time limit. Also state the appellate authority before whom the assessee should file an appeal against such order. Okay. Now, can he file it against, can it be the Commissioner Appeals? No, it cannot be, because DRP, it's itself a collegium of 3 principal commissioners. It's been constituted, or commissioners, which are constituted by the CBDT. So, since DRP itself is a collegium of commissioners, then you cannot file the appeal against that order before the Commissioner Appeals. You have to file it before the IPAP against the final assessment order. So this is a case where the assessee has already filed his objections before the DRP, and DRP has issued directions. AO has issued an order based on that direction. Now the assessee is still not happy with the AO's order, so he has to appeal before the appellate tribunal against the final order. Now what happens? Suppose the assessee chooses not to file objections before the DRP. Suppose assessee doesn't file objections before the DRP. Then what? Does it have any remedy at a later point of time? So that is the MCQ. If ABC Company Limited does not file its objections before the DRP against the draft assessment order within the stipulated time limit, does it have recourse to any other remedy at a later point of time? So the options are, no, it does not have any remedy. Yes, it can file an appeal before CIT appeals at a later point of time, or later on against the final order passed by the assessing officer. Yes, it can file an appeal before the appellate tribunal later on against the final order passed by the assessing officer. Yes, it can file an appeal before the CIT appeals later on against the final order passed by the, even if it has filed an objections against the draft assessment order before the DRP within the stipulated limit. See, one is, if the assessee has filed his objections against the DRP, DRP has issued directions, AO passes an order. That final order is appellable only before the appellate tribunal. But if the assessee chooses not to file objections before the DRP, then it has the option to file an appeal before Commissioner Appeals against the final assessment order. Because in such a case, it has not objected to it at all at the initial stage. So it can file an appeal to the Commissioner Appeals. This is clarified by the CBDT by way of a circular. I hope this point is very clear. Now let me go to the next set of questions. Okay. Now, relating to the facts given in the first paragraph, you have a descriptive question, but only you have an MCQ based on that. So we've dealt with it. Now we come to the next paragraph. It's a very small paragraph. It says that ABC Company Limited deducted tax at source on certain payments made during the previous year 21-22 to PQR Inc. of USA at 20% as per the income tax. Tax is borne by ABC Company. Okay. The DTA between India and USA provides for tax deduction at source at the rate of 15% on such payments. So under the DTA, the lower rate is available. So actually tax could have been deducted at the lower rate itself. But tax has been deducted at the higher rate and it's been borne by ABC Company Limited itself. Now let's see what's the question. What is the percentage of tax that ABC Company Limited can seek by way of refund of excess tax deducted at source on payments made to PQR Inc. USA, assuming that it does not have any further transactions with PQR Inc. USA? Okay. Now, CBDT has issued a circular in 2007. Okay, that circular lays down the procedure for refund of TDS to the person deducting tax, in this case ABC Company Limited, on a payment made to a non-resident in certain circumstances. Okay, it lists out the various circumstances, and it includes a case where tax is deducted at a higher rate as per the Act, whereas the DTA provides for a lower rate of tax. In such cases, the resident deductor can claim a refund provided the resident deductor has borne the tax and he does not have any further transactions with the non-resident. That is also another condition. In that condition also has to be satisfied that the resident deductor should have borne the tax. Tax was borne by the resident deductor, and there are no further dealings with the resident deductor. Non-resident has no further dealings. In this case, both the information is given. The information relating to taxes borne by ABC Company Limited is given in the facts, whereas it does not have any further transactions with PQR in USA is given in the question itself, So information can be anywhere in the case study. So what is the percentage which you will get refund? You can't claim 20% and 15%. It's the difference. Whereas you have deducted at 20% and you should have, it is enough if you are deducted at 15%. So 5% is the answer in this case. The correct answer is B, 5%. And because the conditions have been satisfied. If the conditions are not satisfied, then it is not possible for it to claim. Now coming to the next paragraph. ABC Company Limited is also engaged in the business of extraction of mineral oils in various riverbeds in India after obtaining due permission from the central and state government authorities. It obtained plant and machinery on hire from Right Company Limited, Sweden, who was engaged in the business of supplying plant and machinery on hire used in extraction of mineral oils, and it paid 850 lakhs for the year ended 31. ABC Company wants to know whether it's liable to withhold tax on this payment under Section 194J or under any other provision. Right Company Limited wants to know how this income would be chargeable in India. Okay. Now, what the question here is the descriptive question. Advise ABC Company Limited as regards its liability to deduct tax at source on the higher charges paid to Right Company Limited, Sweden, and also state briefly how the income of Right Company Limited will be assessed to tax in India. And it should be based on the provisions of the income tax, ignoring the DTA. Okay. So when here you're making a payment to a foreign company. When you make a payment to a foreign company, you have to taxes deductible under 195. It is not covered under any of the special provisions applicable to non-residents. It comes under 195. For 195A, tax is required to be deducted by any person responsible for paying any sum chargeable to tax to a non-corporate non-resident or a foreign company. In this case, it's a foreign company. So we have to first see whether some payment is chargeable to tax in India. That we have to see. And before I examine whether some payment is chargeable to tax, I must be sure about the nature of the payment. Only then I can see. In case of a non-resident or a foreign company, it would be chargeable to tax in India if it is deemed to accrue or arise in India. It accrues or arises in India if it's received in India. These things. So if I have to see whether something is deemed to accrue or arise in India, I have to know the nature of the payment. Now, what is the nature of the payment? Here, you made payment for use of plant and machinery, for supply of plant and machinery. Now, is it royalty? First, we have to examine whether it's royalty. Because royalty, as per the definition given in 916 provides the situation where royalty income paid to a non-resident is deemed to accrue or arise in India. Now, you have to examine whether this is royalty. Now, royalty includes consideration for use or right to use any industrial, commercial, or scientific equipment. But it excludes the amounts which are referred to in Section 44B. Okay. By way of higher charges, 44B contains higher charges for using plant and machinery in extraction of mineral oils. Okay, 44B is a presumptive tax provision. It contains, it refers to higher charges for using plant and machinery in extraction of mineral oils in India. But since it's specifically excluded from the definition of royalty, so therefore it is not royalty. In any other case, suppose it was not for extraction of mineral oils, it would have fallen, because it's for right to use industrial commercial equipment, it would have fallen. But in this case, because it's an amount which is referred to in 44B, which is a presumptive tax provision for foreign companies, non-resident, for higher charges for using plant and machinery, therefore it falls outside the definition of royalty. Okay. Now we go to examine whether it's chargeable to tax in India. So why is it that we've decided it's not royalty? Now I don't go into 916 at all. Had it been royalty, I should have examined whether it's deemed to accrue or arise in India as per 916. Now it is clear it's not royalty. So I cannot go to 916. I will come to 911. 911, what does it state? Any income accruing or arising to an assessee outside India, whether directly or indirectly, from an asset or source of income in India, is deemed to accrue or arise in India. So if the source of income is in India, any income which accrues or arises to a non-resident, if the source of income is in India, is deemed to accrue or arise in India. So since here it is for extracting, you're using plant and machinery, higher charges you're paying for using the plant and machinery for extracting mineral oils in India. The source of income is in India, and therefore the income is deemed to accrue or arise in the hands of the non-resident foreign company, Private Company Limited in India. Since it is deemed to accrue or arise in India, it will be chargeable to tax in India, and therefore tax has to be deducted at source under Section 195. I hope it's very clear. We first concluded that it is not royalty. We have to determine whether the sum is chargeable to tax. We have to know what is the nature of the sum, whether it's royalty or otherwise. If it was royalty, we should have determined whether it's deemed to accrue or arise in India as per 916. As per 916, what happens? Any amount paid by a resident will be deemed to accrue or arise in India, except if it is for the purpose of a business carried out in India or source of income outside India. That's the provision which we should have gone into it if it was royalty. But since it is specifically excluded from the definition of royalty, we don't go to 916, we come to 911. 911 states that if the source of income is in India, any income which accrues or arises from an asset or source of income in India is deemed to accrue or arise in India. Since the source of income in this case is in India, the higher charges paid will be deemed to accrue or arise in India. Hence, it will be chargeable to tax in India in the hands of Private Company Limited. Therefore, ABC Company Limited has to deduct tax at source under 195. Now, how do you assess the income tax in India? How to compute the income? See, it's a non-resident engaged in the business of providing services for supplying plant and machinery on hire for use in extraction of mineral oils. This is covered under 44BB. As we saw, it's covered under Section 44BB, as for which it's a presumptive tax provision. 10% of the amount paid, 850 lakhs, would be deemed to be the profits and gains of such business chargeable to tax. So 10% of this, which is 85 lakhs, that would be the income. And what would be the rate of tax? It's a foreign company, right? Company Limited is a foreign company. So the rate of tax is 40%. And since the amount is less than 1 crore, there is no surcharge. You add cess at 4%, so it comes to 41.6%. 41.6% of 85 lakhs, which will amount to 35 lakh 36,000. That would be the tax liability of the non-resident. However, that 44BB provides that you can declare lower profits if you maintain books of accounts and get them audited. So that is the thing. If suppose it wants to declare a lower profits than 85 lakhs, it has to maintain books of accounts and get them audited. So this is what this provision is about. It's a small paragraph, but how do you go about analyzing? If something is liability to deduct tax at source under 195, you have to first determine whether the sum is chargeable to tax. For determining whether the sum is chargeable to tax, you have to know the nature of the sum, whether it's in the nature of royalty or not. Then if it's not royalty, you have to go to 911 and find out whether it is deemed to accrue or arise in India. If it's deemed to accrue or arise in India, it will become chargeable to tax. So the ABC Company Limited would be required to deduct tax at source under 195. So how do you go about computing the total income? Here there are specific provisions in the Act. Presumptive tax provisions are there. Applying those provisions, you have to determine the income, that is 10% of 850 lakhs. And then rate of tax will be the rate applicable to the foreign company plus the cess in this case. Now coming to the next part. There's only one question based on this setup. Now the tax assessment status of ABC Company Limited for the preceding assessment years are as follows. They've given for 3 assessment years. Transfer pricing adjustments have been made. Date of filing return has been given. Then in the last column, they have given what has happened. If for the assessment year 1920, it has gone up to the appellate tribunal and which upheld the addition. And after that, after it has this stage, the ABC Company Limited has chosen not to file appeal. It has attained finality at the appellate tribunal stage. In the second case, assessment year 2021, there again is an adjustment of 205 lakhs. In this case, the AO has made the adjustment and it was accepted by the ABC Limited. 21-22, it decided that suo moto would make the adjustment while filing the return. So the assessee has not made secondary adjustment in the books of accounts for the above said. These are the information. Questions? Questions is, first there's a descriptive question for 7 marks. On the basis of the details of the transfer pricing adjustments made to the arm's length price for the various years, you have to advise the board of directors as regards the time limit for repatriation of excess money and consequences of non-repatriation. Okay. Now, these are the primary adjustments for all these years: 135 lakhs, 205 lakhs, and 182 lakhs. And assessee has accepted it. 21-22 it has made suo moto, 2021 it has accepted the AO order, and 1920 it has accepted as appellate tribunal. Once you have accepted it, then secondary adjustment is required. Because in all the cases, it exceeds 1 crore rupees. If it is less than 1 crore, then it is not required. But in all these cases, since it exceeds 1 crore, the secondary adjustment is required. Once you make the secondary adjustment, then you will have to repatriate the excess money. This amount has to be repatriated. Secondary adjustment is the adjustment in the books of accounts. This is the transfer pricing adjustment is the primary adjustment is by computing the total income. Secondary adjustment is making an entry in the books of accounts. Now, in this case, once you make that entry, then thereafter you have to repatriate the money. The time limit for repatriation is different. It's on the basis of the order of the assessing officer or the appellate tribunal, then you have to, the time limit is 90 days from the date of the order. If you suo moto do it, it's 90 days from the due date of filing the return. When you do it suo moto. And due date of filing, not actual filing. Okay. Is filed the return on 11/10/2021, whereas the due date is 30/11. You are given time limit of 90 days from the due date of filing the return. Okay, so that's what we've given the time limit. In this case, 1920, 90 days from the date of order of IT80. That is 90 days from 24/2022. From this, you have to compute 90 days, which comes to 19/7/2022. And in 2021, it is 90 days from the date of order of assessment order. At this stage itself, the assessee has accepted it. So it's 90 days from 2012/2021. So it's 23/2022. Then third one, AY 21/22, it's suo moto. They have done it suo moto. So you have to compute it from the due date of filing the return. From 30/11/21, you have to do it, and that comes to 28/2/22. Don't make the mistake of doing it from the actual date of filing the return. It's from the due date of filing the return. So this is a very easy question. Now, and what's the consequence of non-repatriation? What will happen? Then what will happen? It will be deemed to be an advance, which the ABC company has made by ABC Company Limited from such associated enterprises. Interest will be computed. That interest will be included in your total income. So interest, what you have within 30, suppose you repatriate within that time limit, then there's no issue at all. If you don't repatriate with the time limit, then in case the international transaction, if it's denominated in Indian rupees, you have to compute interest at the rate of 1 year marginal cost of fund lending rate of SBI as on 1st April of the relevant previous year plus 3.5%. Whatever, this is 9%, it will be 9% plus 3.52 or 25%, it will be 12.25. If it is denominated in foreign currency, Then you have to do it at the 6-month LIBOR as on 30th September of the relevant previous year plus 3%. You have to add 3%. This information will generally be given in the question, but you have to be careful whether you have to see whether it's denominated in Indian rupees or in foreign currency. Then which previous year you have to take? The previous year for which you're computing the interest. Suppose, like, let me give you an example. Like, suppose in this case, it has to be repatriated by 28/2/2022. You have not repatriated. So, your interest will be computed and added. Interest will be computed. For interest computation, I have to start from this date, not this date. Interest computation, at 3% whatever I will be doing from 30/11/2021. So, I will have to do from 30/11/2021 to 31/3/2022. So, my previous year is So my previous year will be 21/22 in this case. So I have to see the rate as an 142, the SBI rate as an 142,021. If I am seeing the LIBOR rate, that is 30th September 2021. I'll have this. 30th September 2021, because I'm computing that interest, I'll be adding it for the previous year 21. So which year I'm going to add the interest, that you will have to take that into consideration. Hope this is clear. It's relatively simple question. Okay. Now suppose it decides not to repatriate. This repatriation, it can be done by the associated enterprise in the country repatriate or any other associated enterprise in the same group country. But suppose it was decided not to repatriate the money. Does it have any other alternative in order to avoid all this interest computation? Yes. There is an option which is provided in 92 CE, which is the secondary adjustment case, that you can pay additional income tax. ABC Company Limited can pay additional income tax, and then it need not make a secondary adjustment. It need not repatriate the money. But how do you compute it? The rate which is given in the Act is 18%. Plus surcharge at 12%, plus cess at 4%. So this comes to 18%, surcharge 12%, cess 4%, it comes to 20.9664%. This I'll have to apply. So it was asking for specifically for assessment year 2021. What is the transfer pricing adjustment for that year? Transfer pricing adjustment for assessment year 2021 is 205 lakhs. So 205 lakhs into 20.96. That we'll have to calculate. I don't remember what it is. 205 lakhs into 20.9664% will give you this answer. 4298,912 as the answer. So it's a relatively simple question. You know, this, if you know the provisions of 92 CE, you'll be able to answer. Just take care when you're talking about the secondary adjustments and all those things. You have to take care. Secondary adjustment will require only the amount exceeds 1 crore. That you have to keep it in mind. And 90 days from which date you have to take, that you'll have to consider. And what rate to apply, which previous year. Like suppose in the examination, you might be given the rates for 2-3, 1/4/2021, 1/4/2022, and all that. So which date you have to take, that you have to be very careful about. Now coming to the next set of information, it is again LMN. LMN Company Limited of London is a holding company of ABC Company Limited. It became resident in India. LMN Company Limited of London is a foreign company. It became resident in India during the previous year 21-22 for the first time due to place of effective management. Being in India, a foreign company, if its place of effective management is in India, it becomes a resident in India. But it's for the first time, it's becoming resident due to the application of oil. LMN Company Limited commenced processing, refining of edible oil and marketing the same by opening a branch at Chennai. On 1/6/2021, it paid 15 lakhs towards cost of ready-to-use computer software purchased from Excel Private Limited of Bangalore. LMN Company Limited wants to deduct tax at source on such payment. Now, first of all, the question MCQ 4 is, is based on that. What would be the rate of tax applicable to LMN company in India? For the assessment year 22-23, 4 options are given. Now, what we have to consider is, it has become resident in India. Now, by virtue of becoming resident in India, would the rate of tax applicable to a foreign company change? That we have to see. Because provisions applicable to a resident will also apply. Provisions applicable to a foreign company will also apply. But as far as rate of tax is concerned, rate of tax in the Act itself specifies for a domestic company and for a foreign company. And the CBDT also has specifically clarified that wherever there's a conflict between the provisions applicable to a resident and provisions applicable to a foreign company, the latter will prevail. Okay, transition mechanism is provided for the first year in that is in 115JH. In case of conflict between the provision applicable to the foreign company as a resident and the provision applicable to it as a foreign company, the latter will prevail. So the rate of the tax of the foreign company will not change because it has become a resident. It will continue to be 40%. And it's given excluding surcharge and cess. So the rate will be 40%. This again is a very simple question. Now, examine whether the amount paid by LMN Company Limited towards cost of ready-to-use computer software is liable for TDS. Also state the circumstances, if any, when such payments would not be liable to TDS. Your answer has to be based on the basis of the provisions of the Income Tax Act. This is very important. This particular thing is very important. You have to answer on the basis of the provisions of the Income Tax Act. Had suppose some DTA being given to you, your answer would be completely different from the answer which has to be given on the basis of the provisions of the Income Tax Act. Okay. Now, cost of ready-to-use computer software. Now, let's see the definition of royalty again goes. Royalty in 916. It includes transfer of all or any rights in respect of any copyright, literary, artistic, or scientific work. There are many other aspects to royalty also, but this is the relevant aspect in this case. It's consideration for transfer of rights. Okay? And this is explanation 2. Then explanation 4 says, this is where it says. Otherwise, from this explanation, you can't make out that in case of ready-to-use computer software, whatever payment you're making, that will constitute royalty. By virtue of this sentence, you definitely can't make out that. It is by virtue of explanation 4, which further states that such transfer of all or any rights includes transfer of all or any right for use or right to use a computer software. By virtue of this explanation 4, because any payment for right to use a computer software, I'm simply using the computer software. I'm purchasing it off the shelf, I'm simply using it. But by virtue of explanation 4, it becomes royalty. So, since it becomes royalty and the amount is paid by LMN Company Limited, it's paid by LMN Company Limited, to whom is it paid? It is purchased from Excel Private Limited, Bengaluru. It's paid to an Indian company. So, Indian company, when you pay royalty, even though the non-resident is paying royalty, tax is deductible at source under 194. Just don't get confused. When a resident is making payment to a non-resident, and that time if you're making payment for royalty, then you have to deduct tax under 195. But here, non-resident is paying to a resident. So, tax is deductible at 194J for this particular purpose. Okay? And 194J में tax is deductible. But the second part of the question asks us whether there are any circumstances when such payments will not be liable to tax at source. CBDT has provided that in case of suppose the software is acquired in a subsequent transfer without any modification by that transfer. It's a ready-to-use software, suppose I purchased. Tax has already been deducted. Earlier transaction, tax has been deducted under 194J or 195. Earlier transaction, tax has been deducted. And the transferee obtains a declaration from the transferor that the tax has been so deducted. In such a case, tax may not be deducted under 194J. So it's acquired in subsequent transfer without any modification. Okay, that is ready to use software without any modification or value addition made by the transfer. tax has been deducted under 194J. This alone, this one condition won't suffice, but already tax has been deducted under 194J or 194 on any previous transfer of software, and the transferee has to obtain a declaration from the transferor that tax has been so deducted. Only in such case, you are exempted from deducting tax at source under 194J. Okay. Now, all this I've said once again, this is your answer because your answer has to be on the basis of the provisions of the Income Tax Act. If there is a Supreme Court case law which is very important, Engineering Analysis Center of Excellence Private Limited, it's a very important landmark Supreme Court. That, always, your provisions of the Income Tax Act and if the DTA, you compare whichever is more beneficial you will apply. Now, the fact is most of the DTAs don't have the provision which is incorporated in Explanation 4. By virtue of Explanation 4 only, Explanation 4 says the transfer of all or any rights. Here, whatever is used in Explanation 2, transfer of all or any rights in respect of any copyright. That includes transfer of right to use a computer software. It's by virtue of Explanation 4, we are this payment becomes royalty and tax is deductible. Suppose Explanation 4 was not there in the Act, then this payment would not have been chargeable to tax. But because Explanation 4 is there, this payment becomes chargeable to tax as the provisions of the Income Tax Act. But DTAs don't have these provisions. They don't have the provision of Explanation 4 generally. They see DTA with Singapore, Australia, Canada, many countries, they have they simply have the use of a right to use any copyright of literary, artistic, or scientific work. It doesn't further add that it includes computer software. In such a case, the Supreme Court decided that suppose the end user, suppose the computer software is purchased by the end user resident in India from a non-resident company or a foreign company, or I'm an Indian distributor, I am purchasing from a foreign supplier and then giving it to an Indian end user, or I'm a distributor, I'm a foreign distributor who purchases from a foreign vendor and later on gives it to the Indian distributors or end user, or whether the software is affixed to the hardware and it's sold as an integrated unit. In all these four cases, does not create any right to the distributors or end users which would amount to use of a copyright. It's very clearly stated. It does not create any right which should amount to use of a copyright. Where I'm an Indian distributor purchasing from a foreign supplier, I'm an Indian end user purchasing from a foreign supplier, or I'm a foreign distributor purchasing from a foreign supplier and supplying it to an Indian distributor and end user, or it's an integrated software and it's integrated with the hardware. So in that case, it does not amount to royalty. So suppose you are given the provisions of the DTA and then asked to answer the question, it will not amount to a royalty. So this you have to keep in mind while you are answering. Suppose I asked it on the basis of the provisions of the Income Tax Act, it would amount to royalty by virtue of Explanation 4, so tax would be deductible. Otherwise, if DTAs are given, majority of DTAs don't have Explanation 4. So your answer would not be royalty. Now coming to the next part of the question. Next set of Mr. Rajesh, a director of ABC Company Limited, is an industrialist and a person of Indian origin settled in UK. During the previous year 21-22, he purchased and sold shares of Indian companies and earned 305 lakhs by way of short-term capital in STPPA. He has no other income which accrued in India during the previous year 21-22. So he's a non-resident. He's purchased and sold shares and earned 305 lakhs by way of short-term capital in STPPA. So he falls under 111. The tax liability has to be determined under 111. Okay. So under 111, your tax liability is 15%. Surcharge, the amount is 305 lakhs. See, normally for any other income, 25% surcharge would have been attracted. But since it is shares of Indian company and 111A is attracted, 111A or 112A and 115AD, in these three cases, even if it exceeds 2 crore, the maximum surcharge which can be levied is 15%. So this is the main thing which is sought to be tested here. One is the main rate of tax is 15%, there's no doubt about that. But surcharge will apply only up to 15% and not higher than 15%, plus cess of 4%. Moreover, since the director and the person of Indian origin settled in US, he settled in United Kingdom, so he's a non-resident. So you can't adjust the basic, unexhausted basic exemption limit also. He has no other income, that you cannot adjust. This is another thing. So basically you have to apply 15% plus 15%. 15 into 1.15 into 1.04, that will give you 17.94% of 305. So that will be this answer. 54,71,700 is the right answer. So here you just simply have to remember that surcharge only at 15% will be applicable even though the amount exceeds 2 crore. And unexhausted basic exemption limit cannot be exhausted since the person is a non-resident, since he's settled in UK. Okay. So these are relating to case study 1 we have completed now. In case there are some questions, let us see first. Sumit Jain, actually you'll end up wasting a lot of time. Just see what the requirement of the question is. Facts you need not be bothered about, you need not repeat the facts and all those things. You remember that you'll be running short of time when you're solving case studies. So see the requirement of the question and the marks it carries also before you answer any question. Many of the questions are for 3 marks, 4 marks, and you just come to the main answer, crux of the answer. Your basic things, points of arguments must be clear before that. Should we read the full case study first and then, of course, you have to read the full case study first. You have to understand what it is. And then only you have to answer the question. But when you're answering the questions, you have to, in fact, go through again to find out where the information is contained. In the first case study, everything, like the questions we could relate to the specific paragraph. But you have to take the question, facts contained in the facts of the case study plus the facts contained in the question and then proceed to answer the question. And sometimes the facts may be spread out in more than one place also. That you have to take care.
Actually, this manual seems suits more in case of case law based questions. In this type, as you have seen in case study 1, the questions are not asking to you answer in this manner actually. This best suits in case of case law based question. Paper 7 generally they asked some certain.
And that when they specifically ask you only like that you have to do it. If it's not asked in such a manner, you may not need to do it in so much detail. Of course, analysis and applicable provisions is there, but facts and writing the issue and
issue is important. Issue is important. You should write. In case of case law, it specifically asks you to decide the things based on certain case law. Then you have to write the issue involved. Then applicable provision, analysis and conclusion.
She's talking about direct tax.
Direct tax. But here in this case study, they are not asking such type of questions.
Because issue they have already identified.
Of course, reading facts again in the case study, because I just want to say analyzing the facts immediately after reading is actually wasting your time. You have to read the question as well. Then again visit the facts. So that you should not miss out any important facts which will change your answer. So reading the facts is very important for you to answer the questions. But of course you have to give a very first reading of all the facts together in one go, then go to the questions, then again see the requirement, and again you have to visit and check the facts again while answering the question.
And one more thing, sometimes the question may not contain the requirement to compute the residential status. It might have given information and based on that compute the total income or compute. But then when you find out that the person is a resident, non-resident, or a not ordinarily resident, many of the facts will become irrelevant. So even though the question doesn't specifically require to compute residential status in that, whenever you are asked to compute the total income or chargeability to tax, you must understand from the facts of the question what is the residential status. only then, like in this question on capital gains itself, had that person been a resident, I would have had to adjust the unexhausted basic exemption limit. The answer would have changed then. So it's very much. And regarding the taxability of income, suppose income earned outside India, it's not taxable in case of non-resident and not ordinary resident. But I might have given the information relating to computation of such income would have been given in the question. Question will not ask you to determine residential status. It will directly ask you to compute total income. But even though it is not spelled out, you will have to do it because your total income, scope of total income depends upon your residential status.
Yeah, and determining residential status, of course, plays a very important role in international taxation. Yeah, the taxability of that person will definitely completely change depending on the residential status. That information you have to find out. You have to identify its residential status.
Simple fact is just because the information is given in the question, it doesn't mean every information has to be utilized also. Like for instance, suppose I've given you the income earned outside India, given you TTR, buying rate, selling rate, so many things relating to property and this thing. But ultimately the person turns out to be a non-resident. Then there is no meaning of that entirely. You will be wasting your time doing all the computation. It's necessary to do the basic determination of the residential status and thereafter proceed.
It might be possible that income is not itself taxable in India. They do not have any, So those kind of information you have to analyze, reading the facts carefully. Now we are moving to our case study 2.
Other students also please ask. We get queries only from Sumit Jain. You can also ask that we know that you are watching.
This case study 2. Basically, case study are based on different provisions. They are integrated based on different provisions of the Act or the DPA or the TAPS, whatever it is. So this case study also deals with in transfer pricing provisions, penalty under the Black Money Act, Black Money Law, Section 10 exemption. Many provisions are tested in this case study too. The first paragraph of this case study is based on is on the non-resident who is engaged in the business of banking. This is on that thing, and it has a branch in India. Let me read because facts are with you. Let me read the facts once again for you. The Alpha Banking Corporation Limited, incorporated in London, is one of the subsidiary of Fee Inc. London, a multinational business conglomerate with activities ranging from manufacture of mobile phones to banking and trade in textiles. Right? Alpha Banking Corporation London opened 4 branches in India. Alpha Banking, we are talking about the Alpha Banking now, and Fee Inc. is the one of the subsidiary. Fee Inc. is the parent entity. Alpha Banking Corporation opened 4 branches in India during the financial year 1920. Each branch was given a rupee-denominated loan of 100 crores by the head office for initial business purposes, that is for advancing loans to borrowers. So the Alpha Banking Corporation is a non-resident foreign entity, and it is a non-resident entity, and it has opened a branch in India, 4 branches. So the residential status of the branch also dependent on the residential status of the foreign company. Foreign company here is a non-resident, and the branch would also become non-resident. So it had given some loan, rupee-denominated loan to the branches for advancing loans to the borrowers. Other information are given that other initial expenses for establishing the branches were incurred by the head office directly and accounted in the head office books. Each branch has to pay. Now the branch, whatever they have borrowed in the form of rupee-denominated bond, they have to pay interest at the rate 6% per annum on the advance of 100 crore. Right, the branches made book entries and have not paid the interest for the year ended 31/3/2022. They have not paid, but still on payable amount also. So, what is the question relating to these facts? And descriptive question is being asked in this based on these facts that you have to examine whether the branches of Alpha Banking Corporation Limited are required to deduct tax at source on the interest payable to head office under the Income Tax Act. You have to answer accordingly. It has 4 branches. The residential status of the branches is also non-resident in India. And this non-resident entity is engaged in the business of banking. For that purpose, Section 9, of course, deeming provisions you have to check. First of all, while determining the tax deduction at source, you have to check whether that amount is chargeable to tax in India or not. Right? For that purpose, again, we have to go to Section 9. Section 915 deals about the interest portion. When the interest would become chargeable to tax in India. When the interest would be deemed to accrue or arise in India in the hands of the non-resident. Below that, clause says that the interest payable by a non-resident would become chargeable deemed to accrue arise in India if it is for the on the borrowings which are used for the purpose of business or profession carried out in India, right? Below that, since both the entities, the head office is a the foreign entity is also non-resident, the branch is also a non-resident. Both are the same things because it's the branch of the same foreign entity. Still, an explanation below to section 9(1)(5) being inserted, which provide clause A of that explanation provides that in case of a non-resident who is engaged in the business of banking, right? In case of business of banking, any interest payable by P in India of such non-resident to the head office outside India shall be deemed to accrue arise in India. So first of all, any interest. What is the interest is payable by the P? P is a branch. Branch is a fixed base in India. So branch is considered P of that foreign entity. Interest is payable by the branch, that is a P in India of such non-resident shall be deemed to accrue arise in India. Right? And in this case, such interest would become chargeable to tax in the hands of that Alpha Inc., Alpha Banking Corporation Limited. Beyond that, the P, whatever will be the profit attributable to that P, is also become chargeable to tax in the hands of foreign entity. Beyond that, the interest portion also become chargeable to tax in India in the hands of the foreign entity. So, how they in such case situation, the P shall be deemed to be a person. You have to treat it as a separate entity. Then all the TDS requirement would be deducted, right? Deductor and deductor would be different. But here they are clarifying that the P shall be deemed to be a person separate and independent of the non-resident person, on which it is a P. So they are considered a separate entity, and all the computation of total income, the provision of tax relating to computation of total income will be determined separately for that P. Determination of tax and collection and recovery provision would also apply accordingly, right? So in such case, the P has to deduct the TDS also on that amount of interest. And in case of non-deduction, again, the 40A1 provision would be applied, that is 100% of disallowance would be attracted for claiming the expenditure by the P. And penalty and interest penalty provision would accordingly apply for not deducting the amount of TDS on that amount. Right. So in this present case, the same thing, interest payable by the Alpha Banking Corporation being person resident in India shall be deemed to accrue rise in India, thus chargeable to tax in India. Accordingly, the tax has to be deducted under section 195 at the rates in force on the amount of interest payable to the head office. So this first paragraph of the this case study relates to this Alpha Banking Corporation, which deals with section 9 provision along with the 195. Now, the second paragraph of this case study, XYZ Private Limited, Baroda, Fee Inc. Already mentioned in the first paragraph, the Fee Inc. Is the parent entity of Alpha Banking Corporation Limited. Fee Inc. Limited has a subsidiary by a name Rhine in Zurich, Switzerland, which is engaged in import of textile goods from Asian retail distributor through outlets in Europe. During the previous year relevant to assessment year 2021, XYZ Private Limited, Baroda, a subsidiary of Rhine, exported goods for 800 crore to Rhine. During the previous year, relevant to XYZ Baroda, a subsidiary of Rhine. Rhine is a subsidiary of Fee and XYZ Limited is a subsidiary of Rhine, right? And it also exported goods for 800 crore to Rhine. Subsidiary and parent company become associated enterprise for the purpose of transfer pricing provisions. Also, XYZ Limited exported goods for 650 crores to various other unrelated parties in Malaysia. TP provisions, for attracting the TP provision, transfer pricing provisions, the entity should be associated entities, and the transaction, whatever be the transaction, is considered international transaction only when they are being entered between the associated enterprises or deemed to be associated enterprises. It had exported goods for 650 crores to various other unrelated parties as well in Malaysia. Now, what is the next paragraph is saying, XYZ Private Limited filed its return of income for the assessment year 2021 in November 20, and it was selected for scrutiny in August 21. The assessing officer referred the case to TPO in October 21 for determination of arm length price. However, it was noticed that the assessee did not maintain the information and documents relating to sale of goods to buyers in Malaysia for a value of 20 crore, which was sought by the TPO. Section 92D. Section 92D deals provides that every person who enters into an international transaction has to keep and maintain prescribed books of accounts in the related documents, which are prescribed under Rule 10D. Right? So every person has to maintain what they have to maintain the details of the international transactions or with the A. Here they have not maintained the information relating to the sale of goods to the buyers in Malaysia. For that purpose, Section 92 doesn't say that they have to maintain the records and the documents for the unrelated entities also. MCQ 5 deals with this paragraph. What the question they are asking you? This MCQ says, what is the quantum of penalty that can be levied on XYZ Private Limited for failure to keep and maintain any documents and information which was sought by the TPO with regard to export of goods to customers in Malaysia? Malaysia may customers are unrelated entities, right? The requirement for maintaining the documents and information is with relation to the international transaction or with the A. Here, there is no requirement. Section 271. Section 271 AA provides for the penalty in case of failure to maintain such books of accounts prescribed under Section 92D. It has not failed in maintaining the international transaction documents. It simply has not maintained for the unrated transaction. So in that case, no penalty would be levied. What is the penalty amount? It is 2% of the international transaction. Right? This is the penalty. Here, since it's not an international transaction, no penalty would be levied. Accordingly, the correct answer would be easy. Next is paragraph. This is the other paragraph of this who says the TPO, based on the information given by the SSC for the assessment year 2021, wants to redetermine. You have to read the word carefully. Redetermine the arm's length price for the earlier assessment years. Namely 1780, 1890, 1920 also. It may be noted that tax assessments were already completed as per the order of the TPO for those years. Already assessments are completed. Based on these facts, MCQ 4 asks you that for which of the previous years can the TPO redetermine ALP in addition to the previous year for which a reference was made by the APO made a reference for assessment year 2021, but he want to redetermine the arm's length price of the assessment year 1780, 1890 or 1920. Can he do it? Can TPO redetermine the ALP which he already completed? Can he do it? The answer is no, because Section 92CA, subsection 2A, which gives some extra power to the TPO to determine the ALP of other international transactions as well, which are subsequently identified by him during the course of the proceedings. So whatever the transaction are referred by the AO, it can also determine the ALP of other international transactions as well. It can do, right? Further, the power are also being given to him to rectify his order in line with the provision contained in section 154. So 154 says the mistakes apparent from record can be rectified by the TPO. Here, what the TPO want to do? Here the TPO want to redetermine. Can he do? Because the 154 simply says for rectification of mistakes apparent from record. But here it want to redetermine the ALP, which is not, that power is not available with the TPO. So Section 92CA has to be referred for this purpose. Accordingly, the first option relates to previous year 16, 17, 18, 19. B option for 18, 19 only. C option previous year 17, 18, 18, 19. We cannot redetermine this thing. So correct option would be D, because since TPO is not empowered to redetermine the ALP of earlier year, which was previously determined by him. Right? This is the correct option. The next facts in this case study are relating to Mr. Ram Mohan. Ram Mohan, former director of XYZ Private Limited. Ram Mohan, age 72 years. You have to carefully see these A's. You have to determine the residential status because this will have an impact on the answers. The Ram Mohan, age 72 years, was the director of XYZ Private Limited in Baroda. He retired in June 9 and left permanently in August 2009. He was earlier there till August 9. He was there, right? It came to the notice of the Joint Director of Income Tax in April 21 that Mr. Ram Mohan had accumulated assets of value 600 lakhs outside India, consisting of residential apartments and deposits in banks. During the previous year, 8-9. During the previous year, 8-9, which were not disclosed for income tax purpose up to assessment year 10-11. When he left in the assessment year 10-11, he left a previous year 9-10, and till that time he had not disclosed the value of these assets in his return of income, for which the return was filed in India. Mr. Ram Mohan was served a notice. He was served with a notice under the black money law in May 2021. Now, Mr. Ram Mohan is saying that is of the opinion that since 10 years have elapsed from the last assessment year in which he was assessed in India, no proceedings could be initiated against him under the Income Tax Act and Black Money and Imposition of Tax Act 2015. No proceedings can be initiated against him. Already 10 years being elapsed. Based on these facts, this MCQ 2 is asking you what is the time limit for issue of show cause notice? What is the time limit for issue of show cause notice? They are saying for levy of penalty of Mr. Ram Mohan under Black Money Act in respect of undisclosed foreign asset. They are not asking you whether they can whether the validity of the notice or not, whether the proceedings can be initiated. They are simply asking you whether the show cause, when the show cause notice can be issued on Ram Mohan for levy of penalty. Assuming that penalty is leviable in this case, right? When it can be issued for, in case of levy of penalty for issuing the show cause notice, 2 time limits are given, where the penalty is leviable under section 41, where the penalty is leviable under section 41 for undisclosed foreign assets, for not disclosing your foreign income or assets. In that case, penalty is leviable under section 41. In case of those penalties, show cause notice can be issued during the pendency proceedings under the Black Money Law. But whenever the proceedings are pending, before levying any penalty, you have to ask to the assessee why the penalty would not be leviable on you. For that purpose, the show cause notice has to be issued during the pendency of the proceedings. When the proceedings will be pending, when a notice being issued, initiated. When the notice is being initiated, in that case, proceedings will be considered as pending on the assessee. Notice already issued in May 21. So in that case, what are the time limits being given to you? There are B, C, D options providing certain time limit 30, 11, 22, 31, 3, 23, 31, 3, 24. However, in case of penalty, since the penalty is leviable under section 41, penalty has to be show cause notice has to be issued during the pendency of the proceeding under the Black Money Act. The other time limit of 3 years is also provided in case of other defaults contained under section 45. That in that case, 3 years time limit is there for issue of show cause notice. However, in case of section 41, the show cause notice has to be issued during the pendency of the proceedings. The next MCQ is also based on the same facts. How much is the amount of penalty which the assessing officer can direct Mr. Ram to pay in addition to tax if the undisclosed asset under Black Money Law is determined at 20 lakhs. So this value they are already giving you. That value of these assets is 420 lakhs. Penalty is leviable under section 41. What is the quantum of penalty can be levied on that amount? It is 3 times of the tax, or right, 3 times of the tax computed. The penalty can be levied under section 41. This is 420 lakhs. 420 lakhs for 30% is 126 lakhs into 3 times. So 378 lakhs is the penalty. Now, this is a very simple question which can be directly answered based on the provision itself, right? Simple question. On these facts again, one descriptive question is also being asked you. You have to now analyze the provision. What would be the liability of Mr. Ram under the Black Money Act? What would be the liability? And examine the procedure and methodology for determination of value of undisclosed assets outside India in case of Ram Mohan, after evaluating the validity of contentions raised by him, you have to examine the validity of the contention. What Mr. Ram had said, Mr. Ram is of the opinion no proceedings can be initiated on him since already 10 years time been elapsed. In this case, Mr. Ram, see, for levying the penalty, the charging section, the Black Money Act is applicable. The levy can be made under the Black Money Act is on the person who are considered assessee. Who are considered assessee in this case? Section 2.2. Section 2, subsection 2 of the Black Money Act define the term assessee, which includes a person being a non-resident or a not ordinary resident in India within the meaning of Section 6.6. You have to go to Income Tax Act to determine the residential status first. If it is a person non-resident or not ordinary resident in India in the relevant previous year, but who was resident in India in the previous year in which undisclosed asset located outside India was acquired, right? So, if he is a resident for the previous year, for in case of undisclosed asset के लिए, the undisclosed asset would be liable to tax in the previous year in which such assets comes to the notice of AO. The AO noticed it in the assessment 21-22, right? 22-23, right? He assessed in May 21. He comes to the notice. So previous year is 21-22. It came to the notice. For the previous year 21-22, Mr. Ram Mohan is not in India at all. So he is a non-resident. However, the accumulated assets, the foreign undisclosed assets were accumulated during the previous year 9-10 के time पे. In that year, he was resident. In the previous year 8-9, he was resident, right? In that case, if he is a resident in those years for which the assets are being acquired outside India, in that case also he will be considered as assessee, and black money law tax would be levied on that person. Accordingly, Mr. Ram Mohan is liable to pay tax at the rate 30% in respect of undisclosed asset during the previous year, the year in which such assets came to the notice of the assessing officer. In black money law, there is no time limitation given. The time limitation is there provided in the Income Tax Act under Section 147. It's 16 years in case of foreign assets, or 6 years. But as the case may be, but here there is no time limit of initiation of proceedings under the black money law. Therefore, proceedings can be initiated against Mr. Ram even though 10 years have elapsed from the last assessment in which he was assessed in India. Accordingly, he is liable to pay tax as well as the penalty levied in the black money law. What is the procedure for determining the value of the assets and everything? For determining the value of assets of the undisclosed assets, the relevant date would be first day of the April of the previous year in which the asset comes to the notice. Means on that date, you have to determine the value of the assets. The notice was served on Mr. Ram in May 21, and the question is the question also said that in April 21 it came to its notice. Notice में आ गया, then the relevant date would be 1st of April 21 would be adapted, has to be taken care, has to be considered for determining the fair market value of the assets. Here, he is also liable to pay equal to the sum equal to the 3 times of the tax to compute. We already computed in that MCQ. Now, the value of undisclosed assets would be the fair market value. That you have to specify the procedure which is given in the study map also. That you have to bring it out here, right? This is the procedure that has to be followed for computing the value of the undisclosed asset. Now, we are moving to the next facts. Mr. Ram Mohan is a non-resident for the assessment year 22-23. He has become a citizen of London since December 2019. He regularly invested in derivatives in India, and he is not a foreign portfolio investor. He earned 6.10 crores during the previous year 21-22 from the transfer of derivatives in India. He is regularly investing it. It is considered as he is investing in the derivative. If a person regularly doing it, it is considered business income, right? And he is a non-resident. And one another information, that is FPO. FPO here is important information to determine the tax liability of him. How it makes difference? Because in case of FPO, the FIA section 115 AD deals with the taxability of FIA or certain income tax AD. It is just a minute. Specify certain rates for taxability of certain incomes in respect of FIA. FIA includes FPI. So, in case if he is a FPI, the taxability would be determined in accordance with section 115 AD, whereas he is not a FPI, right? So, in that case, normal tax rates have to be applied. The tax has to be computed applying the normal slab rates. He has earned 6.10 crores. The basic difference between this, if he is an FPI, in that case, the basic difference is the tax rate. Of course, here you are going to apply the normal tax rates, and here the prescribed tax rates are being specified: 10%, 20%, whatever the rate is specified in section 115 AD, that has to be applied. But the enhanced surcharge, the basic difference, main difference is the enhanced surcharge rate. That enhanced surcharge rate of 25% or 37%, as the case may be, would not be applicable in case of FPI, right? So 15% is the tax rate where the total income exceeds 1 crore. Here the total income exceeds 5 crore. So enhanced surcharge rate of 37% has to be applied for computing the tax liability. 6.10 crores pe normal tax liability has to be computed. 6 lakh is 30%. Then it's Ram Mohan ke liye 79 year is mentioned. Still he is of the age of 79 years. See, in the facts, if you see, go 72 years. 72 years he is mentioned. He has become, since he is a non-resident, he is not a senior citizen. And the higher basic exemption limit would not be available to him. Accordingly, the limit of 2,50,000 has to be, basic exemption limit has to be applied and tax has to be computed. 112,500 plus 30% of 6 crore, it comes to 1 crore 81 lakh 12,500 plus higher enhanced surcharge, higher surcharge rate of 37% since it exceeds 5 crores, 37%, and HEC, health and education, of 4%. The tax liability comes to 2 crore 58 lakh 6,619 in his case. That means you have to read every information very carefully, right? Applying the provisions, applying the tax liability. Next question is on relating to Arnav, nephew of Ram Mohan. Arnav, aged 29 years, nephew of Ram Mohan, went to country gent for higher studies in business management financially 11-12. He visited India every year and his residential status in the Income Tax Act for the assessment year 22-23 is that of resident and ordinary resident. He settled in country gent, where he pursued higher education and became its national. His residential status as per the domestic law of country gent is also resident. He has permanent home and business establishments in both India and foreign country. Seeing the facts, you would be knowing that it's based on the determination of the residential status as per the DTA. As per the DTA, since he is a resident of India also and he is a resident of country Z also, for applying the DTA or the provisions, you have to determine basically for which contracting state he would be resident. For that purpose, you have to apply the tiebreaker. In this respect, question number 6, descriptive question asks you that you have to list the steps involved in determination of residential status of earner when he is resident in both the country. He is a resident of both the contracting state. Now you have to determine the residential status of one of the contracting state only, right? For which he will be considered as the resident. What are the steps for that purpose? Tiebreaker rule has to be applied. There are 4 tests that are being given for determining the residential status of such persons who are resident of both the countries. The first is based on where he has permanent home. You have to list out these things and accordingly conclude about Mr. Ram. Since he has a permanent, it is given in the fact that he has a permanent home in both in India and in country Z. Then you have to move to the second test. What is that test? That where his economic and personal and economic relations are closer. That means where his family, social relations, and occupation, place of occupation, place of business, or place of this thing are there. Preference is to be given to all these things. In this case, he's a personal or economic relations closer to both the countries. He has a business establishment in both the countries, right? Then we have to move to the test 3. What is this? Habitual abode. Habitual abode ke liye, how much time he is staying in what country, what is the frequency of visiting to that country, what is the stay period. He's regularly visiting to India also, he is regularly going to country Z also. Then he again, habitual condition is satisfied in both the countries. Habitual abode condition test is also satisfied for both the countries. We have to move to the last condition. What is that condition? He become the national of country Z. He settled in country Z and become the national of the country Z. Then this test, nationality would determine his residential status of for which country he would be said to be resident of which country, right? In that case, since he become the resident of country Z, Mr. Arnav would be said to be resident of country Z for the previous year 21-22. This is a very simple question based on the tiebreaker which is clearly given in the model text convention. You can easily apply it for determining the residential status of country. Next facts, Miss Kaushalya, sister of Mr. Ram Mohan. Miss Kaushalya, sister of Ram Mohan, came to India on 22nd of April 21 along with her husband Dr. Narayan, who came to India in connection with Cooperative Technical Assistance Program under an agreement between the Government of India and the USA. Both stayed in India for the remainder of the year. They are in India only. Dr. Narayan was paid salary of $7,000 every month by the US government. He has business in USA where his income was $38,000 for the year ended 31-22. Miss Kaushalya has rental income in USA of $14,000 for the year ended 31-3. Both these incomes are taxable in USA and were credited to their bank account in USA and later transferred to their bank account held in India. They are based on these facts. One descriptive question is being asked. Determine the taxability or otherwise of income earned by Dr. Narayan and his wife, Ms. Kausalya, for assessment day 20-23 as per the provision of the Income Tax Act. Ignore DTA between India and US. You have to determine based on the income tax provision. Ms. Kaushalya and Mr. Ram Mohan came to India on 22nd of April. They become resident but not ordinary resident for the previous year 21-22. It means that their global income would become taxable in India, even though the income arising in outside India in USA from the business income or the salary income, everything would become taxable in it. So Narayan also, and in case of Kaushalya also. Is it so? Yeah, but there are exemption provisions are there in respect of the person who came to India in connection with Cooperative Technical Assistance Program under an agreement between Government of India, Section 10(8). Deals with exemptions, providing the exemption to such individuals who came to India. In such cases, the income arising outside India would not be deemed to accrue arise in India, right? Accordingly, the business income, the salary received by Dr. Narayan for US government would not be deemed to accrue arise in India, would be exempt in his hands. And income from business also would not be deemed to accrue arise in India. And accordingly, this income, further condition is there. In respect of this salary income is straightforward, strictly exempt in the hands of Mr. Narayan. But in case of other income, business income, like in this case, which is, if it is subject to tax outside India, then the exemption would be applicable. In the facts, it is clearly stated that both these income are taxable in USA and were credited to their bank account in USA and later transferred to their bank account held in India. So these incomes are already taxable outside India in USA. And accordingly, the exemption provision would be available. This income would be exempt in the hands of Mr. Narayan, business income, by virtue of Section 10(8). In case of Ms. Kaushalya had not come for this purpose. She is just accompanying her husband, and she is also become resident of India. However, Section 10(9) provides for exemption. It says, in case of a family member who accompany such person in India, and then in such case, and that income also taxable or subject to tax outside India, that income in the hands of that family member would also not to be accrualized, would not be deemed to accrualize in India, and accordingly, such income would be also be exempt in the hands of that family member, right? So the rental income in USA is also exempt in the hands of Ms. Kaushalya. This is regarding this case study 2. Let's see if there are any query. I think now we can proceed with case study 3.
Okay. Earth Limited is engaged in trading of electronic goods such as washing machines, refrigerators, etc. It purchases from Associated Enterprise, Sun Private Limited in Singapore, and unrelated party, also Raindrops Bangkok. For financial year 21-22, GP margin, gross profit margin, is 14% on sale of goods of Sun Private Limited, Associated Enterprise, 18% in case of Raindrops. After sales warranty of 6 months was provided by Sun Private Limited. Raindrops gave after sales warranty of 12 months. Cost of warranty may be taken as 2% of sales price. Sun Private Limited brand value is internationally known, and benefit of brand value can be taken as 1% of sale price. During the financial year 21-22, it sold goods of Sun Private Limited for 18 crores and of Raindrops Limited for 12 crores. There was no difference as regards transport cost of goods between related and unrelated party. In the assessment of Earth Private Limited for assessment year 22-23, the TPO selected comparables based on functional comparability. Okay. Here now we are asked to determine which method of ALP would be the most appropriate method and compute the ALP of the transaction. So this is this part of transfer pricing can be very tricky. So you have to see the facts in the particular case. Here, what Earth Private Limited is doing. Sun Private Limited is an associated enterprise. It is purchasing goods from an associated enterprise and selling it to unrelated parties in India without making any value addition. So, and then, therefore, the resale price method will apply. You're purchasing goods from associated enterprise, selling it to unrelated party. And what is a comparable transaction? Comparable transaction, you're purchasing goods from Raindrops Limited and selling it to unrelated parties. That will be the comparable transaction in this case, on the basis of which, and the GP margin of 18%, which will earned from the comparable transaction. 18% was in case of Raindrops. Raindrops is an unrelated party. Sun Private Limited is an associated enterprise. So we have to take into consideration the GP margin of the unrelated party. Now, and proceed to determine after making functional adjustments. Functional adjustment in this case are relating to sales warranty and brand value. These two are the functional adjustments. They say there's no difference in transport cost. So what is the base you take? Base you take, it sold goods of Sun Private Limited for 18 crores. Okay, so that is the base which we have to take. The methodology is clearly specified in each case, in each method. What is the procedure you have to follow? So there may be different ways you present the answer. It is possible to present the answer by making the adjustment to the GP margin also. But that is not what is prescribed by the rules. And it is better to follow the methodology prescribed in the rules for each method. And that is what is given in the study material also. So, now, we found out resale price is the most ideal method in this case. So, resale price of goods purchased from Sun Private Limited is 18 crores. From this, we have to find out what is the arm's length purchase price of Earth Limited. Earth purchased from Sun Private Limited. It purchased, what is the ALP of that purchase price? That is what we are trying to arrive. So 18 crores is the basis. From this, you reduce the gross profit margin of the uncontrolled transaction. What is the uncontrolled transaction? Raindrops Limited. Earth Limited and Raindrops Limited. In this case, 18% is the profit margin. So 18% of 18 crores. Sorry. Will give you 3 crore, 24 lakh. If you reduce that, 14 lakh 76,000 is the arm's length purchase price. But you have to make the functional adjustments. What are the functional adjustments in this case? See, the Sun Private Limited has a brand value which is internationally known, and the benefit of the brand value can be taken as 1% of the same price. So it would be for the brand value, you will be paying more. You have to pay more for the brand value, and that value is also given as 1% of sale price. So that you have to add. Here the sale price is 18 crore in case. Okay. Should not use this arrow at all.
Yeah.
You know?
Gone down now.
So in this case, what happens is that for brand value, you have to pay more. So you have to add that. It's 1% of sale price, 1% of 18 crore, which will come to 18 lakh. And for cost of warranty, the Sun Private Limited provides only for 6 months. Unrelated party provides warranty for 12 months. So for that, you will have to pay less only. So the difference is 6 by 12 of 2%. 2% is the warranty cost. 2% warranty has been given as 2% of sales price into 6 by 12. That is 1% of 18 crores. You have to reduce 18 crores. So you have to add 18 lakhs. You have to add 18 lakhs for brand value because you have to pay more for that, and less for cost of warranty because Sun Private Limited is providing a lesser warranty. So relating to that, you reduce 18 lakhs. So the arm's length purchase price. This is arm's length purchase price of Earth Limited from Sun Private Limited. That should be 14 crore 76 lakhs. So you take resale price of goods. What you purchase from Sun Private Limited, what is the resale price of that good? Then you adopt the arm's length gross profit margin, which is the gross profit margin from Raindrops Limited, which is an unrelated party. So 18% is the arm's length gross profit. So you reduce that, and thereafter you make the functional adjustments. You have to pay more for the brand value, so you add that 1% of sales price, less for warranty because if only Sun Private Limited is providing only 6 months warranty, whereas the warranty provided by unrelated parties is 12 months. So 6 by 12 of 2%, that is 1% of 18 crore, that is 18 lakhs. So the arm's length purchase price will be 14 crore 76 lakhs. Okay. Now, next one is during the previous year 21-22. Earth Limited borrowed 20 crores from Prime Limited, located in country 2. So it's a foreign country. Borrowed 20 crores. The loan is eligible for interest at 8%. Interest payable they've given for the financial year is 140. Okay. Then total asset value of Earth Limited as on the date of loan is 38 crores, and there is no other borrowing made by it except this said loan. There's no DTA. So what is the percentage of borrowing? The borrowing as a percentage of fixed asset, it comes to 20 divided by 38 into 100. It's 52%, 52.63%. So it exceeds 50%. So it's an associated enterprise. Anyway, it doesn't so much matter in this case. In this case, they have just simply asked you what is the amount of tax deductible on the interest paid to Prime Limited by Earth Limited. Okay, Prime Limited is a foreign company. Okay, but the borrowings are given as 20%. It is not given that the borrowings are in foreign currency. If the borrowing was in foreign currency, then interest would be payable at 20%. Tax would be leviable. Tax would be leviable at 20% on interest under 115. Had it been given that the loan was in foreign currency, but here it's not foreign currency, it's only in Indian rupees. So what will happen when you're making a payment? 115A doesn't apply in this case, and you're making a payment to a foreign company. So you have to deduct tax at the rates in force. In case of foreign company, it's 40%. And 140 lakhs is higher than 1 crore, but it's lesser than 10 crores. So surcharge will be at 2%, and cess will be at 4%. I hope it's understood. Had they given it in foreign currency, the rate of tax should have been 20%. So now it's 40%. So 40 into 1.02 into 1.04, That will give you 42.432%. Will give you 42.432% of 140. So the correct answer is B. 59.44. But that doesn't affect the answer. Then Himalaya Company Limited Baroda is the holding company of Earth Limited. It's engaged in manufacturing of electronic goods. Earth Limited was engaged in trading. This is engaged in manufacturing. Babylon, New York has 60% holding in Himalaya Company Limited. Paid up capital is 20 crores of Himalaya Limited. Babylon Company Limited transferred half its shareholding to Himalaya Company Limited or in Himalaya Company Limited. Half of its shareholding in Himalaya Company Limited to MNO in California for 18.04 crores, US dollar 2.2 billion on 30th November 2000 and retained the remaining half of its holding. The book value of assets of Himalaya Company Limited was 20 crores on 31st March and on 30th November it was 22 crores. The aforesaid 60% shareholding in Himalaya Company Limited was acquired by Babylon Company Limited on 1st October 2005 at the time of incorporation for US dollar 2.15 million. Himalaya Company Limited applied for advance pricing agreement in January 2002 and the APA was signed on 10th March 2000. Now let me go to the descriptive. There's an MCQ and a descriptive question. Descriptive question, I'll run through it fast because we have very less time. See, compute the capital gains chargeable to tax in the hands of Babylon Company Limited and the tax liability if the shares are unlisted. Okay, if the shares are unlisted. Now, what are the information given here? Information given is 60% holding. The shares were acquired on 1st October 2015 and it's sold in this year, so it's a long-term capital gain. If it's unlisted shares, what is the consideration is given 18.04. And what's the cost of acquisition? Cost of acquisition acquired by at the time for 2.15 billion. How will I convert it now? I need the buying rate, TT buying rate. TT buying rate is given here in the question. It's given on 1/10/2015, it's given as 60. So 60 into 2.15 million it is. Okay, 2.15 million into 60 into 10 lakh I have to do. That's how I convert it. And divided by 2 because only 50% is selling it. Okay, so it's 645 lakh. So it's 2.15 million into 10 lakh. Okay, it's the cost. 2.15 into 10 lakh into 60 rupees divided by 2. That will give you 645. Sale price is directly given 645 lakh is given, so the difference is long term. You don't get the benefit of indexation. This is taxable under 112 at 10%. Unlisted shares, it's held for more than 24 months, so long term, it's taxable at 10% under 112 without foreign currency fluctuation benefit and indexation benefit. Suppose foreign currency fluctuation benefit was available, I should have computed it in foreign currency. Both in foreign currency, I would have converted it, computed it, then the net figure I'll add, then I'll then I will convert it into Indian rupees. But in this case, the section clearly states that you cannot avail that benefit. So I have to directly compute it in Indian rupees. So it's 11 crore 59 lakh and 10% is 1 crore 15 lakh 90,000. Since the amount is greater than 10 crores, surcharge at 5% would be attracted. Since this is greater than 10 crores. Okay, and cess at 4% would be attracted. Fine, then you get the liability. And the second part of the question is, what if these shares were listed and they've given the FMB of the shares held by Babylon Limited? Entire shares held, it's 1340. Okay, so they've given. Now what you have to do in case of listed shares, consideration will remain the same. Cost of acquisition, what we computed upon. And the other thing, lower of FMB as on 31/1/2018 and the sale consideration. FMB is given for the entire shares as 1340. Now only 50% are being sold. So you have to do 50% of this. That will be 670 lakhs. So 670 and 18.0 crores lower of these two. This is 112A provision. you take, how do you compute cost of acquisition? It's original cost, and then lower a fair market value and sale consideration, you take 6 crore 70 lakh, then you take the higher of these. That will give you 6 crore 70. So the difference is long-term capital gains. Here again, no indexation benefit is available. So it's 11 crore 34 lakhs. And here 1 lakh benefit you will get. Now only the capital gain above 1 lakh will be taxable. So 1 lakh remaining, so it will be 11 crore 33 lakh. You will have to subject it to tax at 10%. Then again surcharge at 5% since total income exceeds 10 crore and cess at 4%. So this is how you get the tax. Okay. So the next question is, what is the time limit for the purpose of furnishing annual compliance report for the year ended 31st March 2020? Here the thing is, wants to apply for advance pricing agreement in Jan 22, and the agreement was signed in 10th March 2020. As for the advance pricing agreement scheme, that as per that scheme, you have to file the annual compliance report. So annual compliance report within 30 days from the due date of filing return of income. Due date of filing return of income is 30/11/2022. So 30 days from that will be 30th December 2022. Or 90 days from the date of agreement, that is from 10th March. So you will have 31 minus 10, 21 days here, plus 30 days in April, 31 days in May, it comes to 82 days. So 8 more days, 8th June. So it's later of these 2 days. It's either 8th June 2022 or 30th 11/2022, later of the 2 days. So later will be 30th December 2022. You have to file the annual compliance report. This is the APA scheme, as per the APA scheme, in rules 10F10. Okay. Next one, Nilgiris Company Limited, a subsidiary of Himalayas, admitted a GP margin of 11% on turnover of 100 crores while filing its return of income. At that time, the data relating to comparable entities for that year was not available when it filed its return. However, at the time of assessment, data of 3 comparable entities are available for the same assessment years. Average GP of the other 3 entities are given 16, 18, and 14%. Okay. Now, what would be the transfer pricing adjustment in the hands of Nilgiris Company Limited for the assessment year? The reported turnover of 10 crores, taking note of the GP ratio of the comparable entities. So 4 options are given: 200, 300, 500, and 1,000,000. Okay. Now, how do we proceed? What is the provision in this case? You have to go to the rules. Rule 10B4 says that you can take only the current year data for analyzing the comparability. 10B5 says where the most appropriate method is either the resale price or cost plus or TNL. Then you can either use the data for current year or data relating to the financial year immediately preceding the current year if current year data is not available at the time when you furnish them. So it is okay. In this case, what is the method which is being used? It's given. They've given the gross profit margin at 11% of turnover. So it has to be the resale price. It can't be cost plus. Cost plus is as a percentage of cost. It can't be TNMM because that is the net profit margin. Here it's the gross profit margin, so it's resale price method. So in case of resale price method, the company can do it on the basis of last year's data. They can file the return. There's no issue about that. But subsequently at the time of assessment year, when current year data is available, then however, where data relating to current year subsequently available at the time of determination of ALP during the course of assessment, the current year data has been used irrespective of the fact that it was not available at the time of filing. So now at the time of assessment, when the current year data is available, gross profit margin of 3 and the comparable entities is given, I have to compute my ALP based on this date. Now, even though this was not available at the time of filing. Now these 3 data is available only. It's a 3 entries. For constructing data set, I need 6 or more entries. Now, since only 3 entries are available, as per the TP rules, I have to take the arithmetic mean. Arithmetic mean is 16 plus 18 plus 14 divided by 3, that will give you 16%. What is the percentage which I have applied? I have applied 11%. So the difference is 5% on 100 crores, which is 5 crores. So the correct answer is 500 lakhs. Himalaya Limited entered into an agreement for import of electronic equipments from Andes Inc. of Colombia. The agreement envisaged that the electronic components imported would be assembled in the warehouse owned by Himalaya Limited by the employees of Andes Limited who visited India and deputation. They applied for advance ruling. Himalaya Company Limited applied for advance ruling in April 21 to know the tax consequences in the hands of Andes. With the advance ruling pronounced on 30/9/2021, it is pronounced on application was on 1/4/2022. But advance ruling was pronounced on 30/9/2021. It's within the time limit of 6 months, but we have to see that. On the basis of application filed by Himalaya Limited, be binding on Himalaya Company Limited and Andes Limited. If not, is there any remedy available? If the applicant is aggrieved by the advance ruling. Okay. Now, as I told you in the beginning of this session, the provisions for advance ruling have undergone a change. Authority for advance ruling. 1/9/2021, whatever cases are pending, it is now transferred to board for advance ruling. Okay, so board for advance ruling. So since the advance ruling was pronounced on 30/9/2021, from 1/9/2021, AAR ceases to exist. So the ruling can be on 30/9/2021 would have been pronounced by the BAR. This 269 SS earlier, it used to provide that the advance ruling is binding on the applicant, it's binding on the transaction, it's binding on the principal commissioner and the subordinate authorities, all these things. But this 269 SS is not applicable in the bar regime. This provision is no longer applicable. So, the advance ruling pronounced is not binding on the applicant. It's neither binding on Himalaya Limited nor Andes Limited. And there's a new provision 269W which permits the applicant to, if he is not satisfied with the ruling, if he is agreed by the ruling, to appeal to the High Court. So the correct answer is, it was pronounced at 39,021. Had the question said, now the correct answer is it would not be binding on Andes in court. Correct answer is no, the ruling would not be binding on Himalaya Company Limited or Andes Limited. An appeal can be filed before the High Court by Himalaya Company Limited if it is agreed by the advance ruling. This is because the ruling is pronounced on 39/2021. After 1/9/2021, the ruling is being pronounced by bar, and therefore 269 SS does not apply in this case, and the appeal can be filed before the High Court as per 269W. But in the same question, instead of 39/2021, had the date been 31/8/2021, the answer would have changed, because 31/8/2021, it would have been by the authority for advance ruling, then it would have been binding. So you have to be very careful about the date which is given in the question. At the time of applying, is applied to the AAR, but who has pronounced the ruling? It's the BAR which is pronounced. How do we infer that? Because it was pronounced on 39/2021, and from 1/9/2021, the AAR had ceased to exist. And so all the cases have got transferred to the board for advance ruling, which has pronounced the ruling. So the correct answer is D. No, the ruling would not be binding on Himalaya Company Limited or Andes Limited. An appeal can be filed before the High Court by the Himalaya Company Limited if it is agreed by the advance ruling pronounced. Rahul, nephew of Managing Director of Himalaya Company Limited. Rahul is the nephew of Managing Director of Himalaya Company Limited. He is born and brought up in India. He left India for employment in country N on 5th June 2013. He has gone outside India. He is now outside India. He is in country N. He regularly visited in India and stayed for 60 days in every previous year, since previous year 2015. In the financial year 21-20, Rahul came to India 1st May 2021 and remained till 31st August 2020. His salary was 3 lakhs per month, which he earned for 8 months during the previous year 21-22, which was credited to his bank account in country. For the remaining months, they paid him salary. These are 4 months. May, June, July, August are 4 months in India. For the remaining 8 months, he got salary in country and that was credited to his bank account in country. He also has an income from house property in Pune, computed 22 lakhs. He does not pay income tax in country and where he is employed, as there is no income tax law in that country. Now the question asks you to determine the residential status of Rahul and compute his total income for assessment year 22-23. That's the first part. Let's do the first part. Okay. First part, you have to go as per the facts given in the question. Now for determination of residential status of an individual, what are the conditions? First, 182 days stay in India or 60 plus 365 days. But in case of an individual he is born and brought up in India and he left for employment. He's a citizen of India. That is also excluded. In case of a citizen of India or a person of Indian origin who living ordinarily outside India comes on a visit to India, then 63-65 condition will not apply in the same form. Instead of that, 120 plus 365 days conditions will apply. Okay, so it's either 182 days, 120 plus 365 days. Also, in case of a deemed resident, 6(1)(a) talks about the deemed residential status. That in this case, because he does not pay income tax in a country, in country and where he is employed, as there's no income tax law in that country. Okay, but 120-365 condition will also apply provided his total Indian income exceeds 15 lakhs. Indian income, not foreign income. Okay, and in case of a deemed resident is a person who doesn't pay, is a citizen of India who does not pay tax anywhere outside India. And in such a case, if that person's Indian income exceeds 15 lakhs, he would be deemed resident. Both this 120-365 case as well as in a deemed resident case, the person would be resident. If the person is a resident, by default, he would be resident, not ordinary, without going into any further condition. So these are the provisions which we have to see. Now, how do you determine the residential status? Now, is he fulfilling? How many days has he stayed in India? He stayed 31 days in May, June 30 days, July 31 days, August 31 days. So it is 123 days he stayed in India. Okay. So 182 days condition is not applicable. Resident he doesn't satisfy. 60 plus 365 is not applicable in his case, as I told you. 120 plus 365, 120 days he satisfies. Okay, 120 days, first of all, whether it's applicable to him, does his Indian income exceed 15 lakhs? You have to see that. Yeah, his income in house property is 22 lakhs. Okay, so his Indian income exceeds 15 lakhs. The salary income, of course, you don't take because it's earned outside India and credited outside India. So Indian income, 22 lakhs exceeds 15 lakhs. So 120 plus 365 days condition also you will have to see whether to determine whether he is resident. He is in India for more than 120 days? Yes. Is he in India for more than 365 days during the 4 immediately preceding previous years? That is also there. Now it's not simply 120 days. It's 120 days in the current year plus 365 days in the 4 immediately preceding years. So the question is given, he stays in India for 60 days every year in every previous year since previous year 2014. So 60 into 4 is 240 days. So current year, he stayed for 123 days, but in the immediately preceding 4 years, he stayed only for 240 days. So he does not satisfy this condition. So by virtue of these two conditions, he is not becoming resident. He is not satisfying. Now we go to deemed resident status because he does not pay income tax in any country that is employed, since there's no income tax law in that country. Deemed resident does not require a stay in India. Your income should be more than 20 lakhs. Indian income should be more than 15 lakhs, sorry. It should be more than 15 lakhs and you should not pay tax anywhere else outside India and you should be a citizen of India. So he is a citizen of India. His Indian income exceeds 15 lakhs, it's 22 lakhs and he does not pay tax in country. So by virtue of 6(1)(a), he becomes a deemed resident. Deemed resident is by default a resident but not ordinarily resident. So in that case, in case of a resident but not ordinarily resident, what is the income chargeable to tax? Income earned outside India will not be chargeable. Income earned in Pune will be taxable. Plus, if he had any income earned outside India from a business setup of business in India or from a profession setup in India, that would have been taxable. But in this case, such income has not been provided. So only 22 lakhs would have been taxable in this case. Okay, this is the first case. Second case, would your answer change if Rahul pays income tax at 15% in country? If he pays income tax at 15%, then the deemed resident provisions will not apply to him. Deemed resident 618 provision will not apply to him. So you have to go on the basis of 61 provisions, that is 182 days or 120 plus 365 days. He doesn't satisfy either condition. 182 days also he doesn't satisfy. 120 plus 240 only he has. He doesn't have 365 days. So neither condition he satisfies. In that case, he would be a non-resident. Once again, only the income earned outside India will be taxable. In India will be taxable. Income earned outside India would be exempt. So 22 lakhs would be taxable in that case. So the taxable income in both cases is only 22 lakhs. Only thing, it would have been made a difference had they given income from business setup or profession in India. If they had given that information, then it would have been made a difference in both cases, which they had not. So in the first case, he is a deemed resident. In the second case, he is a non-resident. Detailed answer is given, detailed explanation is given in your book. So that talks about case study 3. Do we have any questions? Let's see. Okay. So our time is up now. Like actually, we would like to do the other 2 case studies also, but since we do not have time, in case you have any queries, you can send it to us. The email IDs are available at the viewers knowledge portal. You can send it to us and we'll be happy to reply to you. And wishing you all the best for your exams.
You can also ask a query through a mobile app, ask the query portal. In case you have any doubt related to any question and strictly on the MTP, you can ask there also. And yeah, of course, wishing you all the very best for your exams. Take care of your health. Take care of your things properly. And yeah, you will definitely going to do well.
All the very best. Manage your time effectively, your time preparation time as well as your time during the examination. Don't waste time. Don't waste any point of time for preparation also and in the examination hall also. All the best. All the very best.
All the best. Thank you so much.